and text. So once again, welcome to our first MarketSense Live since the think tanks. I'm going to start out by just reintroducing our two analysts that'll be here with you today. Also, if you have any questions, the chat function is open, so please put your questions there. Or you can text your advisor and ask a question that way, and they can make sure that they get it to us. I'll check my phone as well a couple times for questions. So thanks for joining us. I hope seating's going really well for everybody. And we'll get started right into it. So the two presenters we have today with you are two of our analysts. So we'll have Ed Broshinsky and Gerard Grayling. And with that, we've got a pretty packed agenda. So I think we're just going to jump right into the good stuff. So welcome again. And thanks, Ed and Gerard, for coming on today and sharing all your insights.
Thanks, Heather. And like you said, yeah, we've got a packed agenda. We're going to try to get through just about all of the commodity groupings that we deal with here at MarketSense. And so let's get into it. First things first, let's just go through a quick agenda. We're going to do a think tank plan review, so kind of just a recap of what we were thinking 3 months ago, and an update of where we're at in regards to that plan and whether or not there needs to be any modifications to the plan. We'll talk quickly about crop conditions and seeding progress in North America, and then go through the oilseeds, wheat, talk about feed grains, corn and barley, pulses, peas and lentils, durum and oats. And then hopefully, if we got a bit of time, we can quickly touch on currency, macroeconomics, and have questions throughout. So speaking of the think tank review, the theme of the think tank this year was defend the castle. And the idea there was that there's, over the past several years, there's been kind of a good commodity prices, not necessarily great growing conditions, but the ability through higher commodity prices and what crops we did grow in Canada to build some wealth, right? Also land values appreciating, right? So building wealth, equipment values appreciating, wealth on the farm. So building that castle has been kind of built, and now in this more challenging environment, the idea has been to defend that wealth, defend that castle of the farm enterprise that all of you are running. The way I wanted to look at kind of some of the commodity groupings that we deal with is in that lens of defending the castle. So what are we doing with a certain commodity? Are we still in the defensive mode? Are we adding more defenses? Are we building new walls? Are we digging a deeper moat? Are we just maintaining the defense, or are we potentially making some incursions into enemy territory and going on the offense, right? More of a bullish strategy. So this is a recap of where we're at today. And for oil seeds, we'll go into the reasonings why, but we're in a strengthening of the defenses stage, right? We want to actually redouble our defenses against some headwinds, some attacks that are likely to come this year. With wheat, we're in a maintenance stage, so not a necessarily, so something that the wheat market's starting to resemble something more of a neutral range-bound market. I know we've had a big rally, we'll talk about that, but over the long term, the goal of this presentation is to give us a long-term outlook, and in the long term, we see more of a neutral wheat market. Same thing with barley, corn, and feed grains. So we're maintaining that defensive stance. Now with peas, we've seen some really good developments, some more bullish developments, quite frankly. So we're looking at an offensive stance there. So defending the castle has actually involved taking on a bit more risk, leaving a little bit more unpriced for peas because of the opportunities that we've seen. Lentils is a maintenance, so some risks, some opportunities. We're maintaining defense. Durum, strengthening the defenses, worried about some pretty major headwinds to come. And then oats have seen some more opportunities in the oats market ahead, and for that reason we've got a more optimistic view, looking to go on the offense for oats. So that would be, back at Think Tank, we were kind of defend the castle across the board, and now we've picked and choose. There's a little bit different, some differences in the different commodity groupings around our defensive stance. So remember, what we've seen in the markets now has been expected. It feels in the moment like a lot of this stuff is unexpected, perhaps some surprises from the WASD, from weather, from demand and supply. But overall, this is a typical spring market volatility that we're seeing. If we recall back in Think Tank in February, March of 2024, we were saying that there will be bear market rallies going forward. We're in a bear market, but there's going to be rallies. They're going to be very strong. They're going to be exciting and exhilarating. They're going to feel like a new bull market is beginning. They're going to have, in this case, an evangelical property. They'll be bringing people over to the bull camp. There might be a little bit confusing too. What's going on? You might say that with canola today. Why is it up? There's a lot of bearish fundamentals. Why is canola market up? Now that's pretty classic confusion that occurs in a bear market rally, and uncertainty too. This doesn't add up. These supply and demand charts don't really make sense given the price action that we're seeing. These are some of the questions that we're seeing today, right now, through this springtime rally that we've seen across a lot of these commodities. And I think it's important to just remember that 3 months ago, we were planning for this, and now is the execution phase, right? The planning phase for the spring market rally is over. We are now executing. That execution involved that planning involved setting goals, building different scenarios of what the price could do, what the market could do given certain events, but most importantly, measuring the risk involved and then executing against the plan. And you see this kind of battle plan, right? We've seen this. This is like more of a military analogy here, but we've seen the market come at us, right? There's been offensives. We've defended, right? The market's now given us an opportunity, but we have to be vigilant and remember that there's secondary and tertiary offensive likely headed our way across some of these commodities. So we are executing, and we are in the final stages of a spring selling program. The spring selling program that we identified during Think Tank is nearing its conclusion. You have seen a lot of sales recommendations in the past few months. We've increased the frequency, and I know it's been stressful, and thank you for kind of bearing with us along the way. But this is part of the plan, and so far we haven't seen a big reason to change the plan away from this idea of making sure that we're getting good sales on the books through the spring season. And we are nearing the end. So there's a few more sales recommendations to come, but we are nearing the end of that spring selling program as we get closer to the end of May. And so that's a recap. That's where we said we were going to go at Think Tank 3 months ago. Where we are today is still in the execution phase of the plan. We're nearing the end of it. Any questions about that broad overview before we get into the specific commodities?
There's nothing here in the chat for questions, but we can circle back if somebody does.
Sounds good. And just to reiterate, I think it's really important that we kind of remember where we were and why we're here today, because it's really easy to get caught up in the moment, right? To caught up in the noise, caught up in the spring market volatility. It's really exciting. It's a new year. I think it's really important to remember, okay, yeah, no, everything is going according to plan. This is what we were hoping for, and now is the time for execution and clean execution. So let's dive into a little bit of the here and now before we start getting into the long term. We'll get into crop progress. This is the Canadian crop progress. I have made some estimates for where we are here at this now we're in the third week of May, but for the last week's progress, because we haven't got all this the provincial seeding reports yet. We did get, for the first week of May, we saw that Manitoba was behind schedule. We were seeing that Saskatchewan was behind schedule as well. Saskatchewan catching up pretty significantly this week, or last week, I should say. Manitoba also catching up, between 20 and 30%, kind of average across the board. Alberta, this blue line, Alberta is ahead of schedule. The reason why Alberta seeding is ahead of schedule, first of all, is because in the south, they always get, in southern Alberta, they're always getting ahead. That's kind of a hallmark of southern Alberta. They're the first ones in the fields. But the different thing this year is that the Peace Country, northwestern Alberta, the far northwest, is ahead of schedule. It's been very dry there. They haven't had the rains that the rest of the prairies have got, and so the Peace Country is well ahead of normal planting pace. So that's contributed to Alberta being ahead of pace, while Saskatchewan, Manitoba, a little bit more rain there, a little bit more broad, have fallen behind. That said, on average, when you look at this chart, you can see Canadian planting progress on average is more or less on pace with a normal year. In the United States, corn planting progress was more or less at average. Depending on how you calculate the average, you could argue that it was below if you calculate it the way the USDA does. The way we calculate the average is we just average the last 5 years. Whether or not the planting progress date came out on the exact same day as it did last year doesn't really matter. We kind of average out the weeks. And so based on our averaging process, corn planting is essentially right on schedule in the United States at 49% complete. US soybean planting progress is at 35% complete. Average is about 39, so slightly behind average pace on soybeans, but again, more or less on pace in the United States. So spring seeding delays have slowed a fast start to the year, but so far no major seeding delays in the United States. Hard red spring wheat, 61% planted versus about 50% planted on average. So spring wheat going in the ground very quickly in the United States. They've been doing a lightning quick seeding campaign there in the Dakotas. Crop scores for US winter wheat steady week over week at 50% good to excellent. So that is better than the average, which is 44%. A great deal of that, stable, steady crop condition ratings are coming from the soft red winter growing areas in the Eastern Corn Belt. So really good conditions for soft red wheat, the Chicago wheat. Meanwhile, Kansas wheat, I would argue, has stabilized, but the recent rains, we have not seen a very big uptick in crop conditions from the recent rains in Kansas. So that's a big question that is going to be answered. The Kansas crop tour starts today. So there's going to be agronomists going all over Kansas over the next few days. You're going to see pictures on social media. You're going to see head counts, yield estimates, and we'll see if this Kansas crop score kind of fits with reality, and we'll see if those rains have had any effect on the crop. So that is the here and now. We are going to switch, and I just want to kind of make it clear that our focus on this MarketSense Live is to give a bit more of a longer term outlook, a bit more of a broader overview of the commodities. We're not going to try to focus on what the 5 or 7 day forecast is, although certainly the rains in the 7 day forecast will affect our crop outlook. What we really wanted to say is, what are we going to do in the next 90 days, right? Through the growing season, is there any kind of major things that we need to keep an eye on? And that's more of a fundamental outlook rather than a very short-term weather outlook. So before we do that, any questions, Heather, on the crop ratings?
I don't see anything yet. I am worried though that if the chat's even working. So can someone just write test or something in there for me? Because usually there's a few by now. Okay, yeah, we're working.
We're good? Okay.
Yeah, thanks everyone.
Okay, so let's get into oil seeds. Oil seeds are a very interesting topic right now. There's several different pieces that are affecting the market. Some of them long-term, some of them short-term, some of them meaningful. some of them just headline clickbait, and we'll try to disaggregate some of that for you. First of all, let's just start with beans. I think beans are the leader of the complex, and what is going on with beans? Well, the biggest headline lately has been this disruption to the late season South American bean harvest, primarily Rio Grande do Sul, the southernmost state in Brazil. Massive flooding, deadly flooding. They're saying the worst in 80 years. And that's disrupted the last quarter of their soybean harvest, and it's also flooded out a lot of bins and shut down some of their crush facilities and export facilities there. Rio Grande do Sul is the second largest soybean grower in Brazil, so a pretty important state. Normally at this time of year, we are done with South America. It's over and done with, but it's that weather issue has dragged that old crop South American harvest out a little bit longer than normal, and it's kind of that weather story is bleeding into the North American growing season. The thing is that if right now the market or last week the market was worried that these flooding in Rio Grande do Sul would lead to more demand for old crop U.S. beans. If that doesn't occur, then there's potential, and we'll show you in a moment, potential for major stock builds for soybeans in North America, also globally. And that is the longer term concern that we have for oil seeds and that's causing us to want to redouble our defenses in the oilseed market. Rio Grande do Sul, southernmost state in Brazil, was at 75% harvested as of the 5th of May. That's kind of when the rains really started hitting, kind of late April, early May. There was some small amount of harvest activity that occurred last week. They harvested about 4% of the crop in Rio Grande do Sul last week. So they're at 79% harvested. Again, those rains, massive slowdown in progress there. Normally they'd be complete at this time of year. Rio Grande do Sul is responsible for about 22 million tons of bean production this year in South America. There's about 7 million tons at risk in Rio Grande do Sul. Of that, we're estimating 2 million tons may have been lost, 1 to 2 million. Markets saying 1.5. Some people are saying 3. I would argue that it's probably 2 million tons. So the big question is, will the United States get any of that? The rule of thumb usually is that if there's crop losses in Brazil, about half of that comes back to the United States in the form of demand. So maybe 1 million tons of the 2 that's been lost comes back to the United States. That is 36 million bushels. Now, I think last week on our weekly call, I said 360 million bushels. That was a mistake. I had the decimal place wrong. I said, wow, if 1 million tons come back to the United States, the US could run out of beans, and that was not accurate. If 36 million tons or 36 million bushels of demand comes back to the United States, 1 million tons, 36 million bushels, that would definitely tighten up the ending stocks for old crop quite a bit, but they wouldn't run out of beans. So I wanted to clarify that from last week. In any case, the market so far hasn't seen that demand come to the United States in style. That's part of the reason why soybeans haven't been able to rally a whole lot farther than where they did last week. Why? Why is that? Well, here's the thing. Argentina and Brazil and Paraguay, total South American production on this slide showing 215 million tons of production this year. That's 9% higher than last year. So despite the losses in South America, despite even the losses in Rio Grande do Sul, still a record bean crop in South America. And the USDA on Friday is forecasting an even larger crop next year. Now, they haven't even finished harvesting the old crop, so to say that next year's crop is going to be larger is a bit of a stretch. But at this time, we don't know that. And given a 3% increase in acres in Brazil, that's what it assumes. That's what they've been doing every year for the past several years. And assuming a slight increase in yield, so 0.6 bushel increase in yield, 54.1 bushels per acre is what they're projecting. that would produce a massive crop next year in Brazil. So some long-term pressure potential against oilseeds. What does that mean for global oilseeds? Well, in this next slide, we have the global major oilseed production. We have soybeans stacked, palm oil, rapeseed oil, sunflower seeds, all stacked on top of soybeans. And we see that next year, total production of oilseeds in the world is about 650 million tons. That is a significant increase over the previous year, which was a record at about 625. So global oilseed production ramping up in a big way, even despite the losses that we've seen in Brazil. Global oilseed of all oilseed production is up huge. So that's part of the reason why we're wanting to defend the castle pretty heavily for oilseeds. Now, of course, we still need to grow the North American crop. We haven't even seeded it all yet, and we're calling for this massive increase in production. And I think a criticism would be, Ed, we haven't even grown our crop, let alone the South American crop. So, what's going on with weather, acres, and demand? Well, we talked about planting progress. So far, U.S. soybean planting progress is essentially on schedule. Doesn't appear to be any issues there. With precipitation, the North American oilseed crop, specifically U.S. beans, is in good shape. Iowa has received 5-6 inches of rain in the past 30 days, most of Illinois as well. The corn belt, the soybean growing belt in the United States, is in perfect moisture shape. You could say excessive moisture shape, but probably in a few weeks, we'll have people wanting rain. That's usually how it is. But in any case, definitely no problems from the moisture scenario. So can the United States grow a record soybean yield next year? So far, looks like they can. When we look at the average soybean yields over the years, the USDA is predicting a 52 bushel yield for US beans next year. Is that realistic? Well, they did it in 2021. It was a 51.8 bushel yield. In 2017, the US yield was 51.9. Saying a 52 bushel yield, yes, technically it's a record, but the US has been there before. So I think a lot of people are saying, well, it's too early to predict a record soybean yield in the United States. I would argue, I don't think it's totally unreasonable to predict that 52 bushel yield. So yeah, is the weather okay? Yeah, there's some planting delay issues, but the weather's generally okay. And the yield expectation is not out of the realm of possibility given today. And if you use those yield numbers, you see soybean ending stocks in the United States rising potentially 30% year over year. So this is where I'm talking about, is that we've got the short-term opportunity in the market, long-term, huge build in ending stocks in the United States year over year. That translates into a huge build in world soybean ending stocks, global ending stocks, 15% increase globally, 17 million tons year over year. Some major headwinds for the oilseed market coming from the soybean side in the next 12 to 18 months. We want very badly to defend the castle for oilseeds, and as a result, we've advanced sales recommendations on beans. We've even started 5% on 2025 beans. So that's November 2025, 2 crop years out, because of some of this pressure that we see coming down the pipeline for oilseeds. And that is how we're executing against defend the castle mentality for oilseeds. We'll go into canola now, unless there's any questions.
Nothing yet.
Now for canola, it's going to be correlated to soybeans. That's why I wanted to start with the beans, but canola has some of its own fundamentals as well, and we'll go into some of that. The thing with canola is that we have seen a major improvement in Canadian moisture conditions, so some of the drought concerns have dissipated for now. Still some soil moisture deficits across the prairies that need to be corrected. but we've gone a long way. We've made a lot of progress into correcting some of the drought conditions over the past month. Canadian canola production is expected to increase year over year, so production increase, but there's also an increase in demand expected with new crush capacity, better exports. So the thing is though there's an increase in production, it's offset by an increase in demand. At the end of the day, ending stocks still just remain large. They don't necessarily grow year over year, which is good from a price perspective, but they don't really get a whole lot tighter either. And so we're looking at another year of fairly large canola stocks next year. As a result, we want to defend the position on canola that we have. From a moisture perspective, this is at percent of average precipitation. You can see essentially across the prairies, 100 or better percent of average since April 1, except for the Peace regions in northwestern Alberta. Hopefully we do see some rains in the forecast actually confirm for that part of the country. And this is another look at that last 2 weeks of rain across the prairies. So everybody across the prairies, except for the Peace, has received roughly an inch. Some areas even higher, close to 3 inches in southern Alberta. So the reason I show those charts is I say, well, today on May 14th, it's very early, but can we rule out a trendline yield? Like, can we say, no, trendline yield is not achievable today? I would say no. I would say a trendline yield, which is what we're forecasting, 40 bushels per acre, is reasonable. And I think it's especially reasonable considering if conditions are really good. If you look back to 14, 15, 16, 17 canola, Canadian average yields were 41, 42, or even better. So projecting a 40 bushel average yield, which is trendline for canola, is, I think, well within the range of possibility. If that is realized this year with the acreage that we're assuming, Canadian canola ending stocks stay well above 3 million tons for the 24-25 crop year. Now we do assume demand's going to increase a lot. We're looking at demand next year at 19.5 million tons for canola. That's plus 10% year over year. So a big demand increase we're expecting next year, primarily thinking that Europe's going to come in and buy some canola. Last year, Europe was exporting canola to us. We think that Europe will be an importer of Canadian canola next year. So that's going to be a really good thing for our demand profile, hopefully diversify away from over-reliance on China. We're also seeing crush capacity increase. So we're looking for an extra 800,000 tons of crush for next year. The previous record demand for canola was 21.3 million tons. So we're forecasting 19.5. Part of that reason is because we've lost some export market share over the years to Australia, to Ukraine, to Russian exports as well. So ending stocks in Canada stay high, though, even with the demand increase. And that contributes to global ending stocks. So the previous thing that we talked about was global production increasing. We talked about soybean production increasing. We talked about canola production increasing in Canada, and how that all filters back into global oilseed ending stocks shows a record ending stocks of oilseed. So that's soybean, palm, rapeseed, canola, and sunflower. And we're seeing record ending stocks globally. So that is going to really create some major headwinds in the upcoming year. And if we've got opportunities to make money, make a profit in the oilseed market, we need to defend those profits. So the canola outlook is, in summary, a general global push to produce more oil seeds is exceeding demand capacity. Demand is increasing, yes, but production is outstripping that for the next crop year. We are in a long-term stock building cycle. So global stocks are building over the next year, maybe two, until that demand catches up. Demand will catch up. If you build it, they will come. But usually the supply exceeds demand, and then prices come down, and then demand comes and catches back up. That's the cycle that we're in. So we're in the prices come back down, demand catch back up phase. We're not in the prices going up phase that we were in 2 years ago. So our core position is to reinforce our defensive stance. We want to make sure that we're cleaning up 2023 crop. We want to move, prudently against 2024 crop. That includes, moving to 50% sold on new crop canola, potentially moving beyond that with different marketing tools, and even considering, and I would consider for canola too, if you're able to put on some 2025 hedges using price lock, consider that maybe the first 5% of your 2025 crop. We've already done that with soybeans. We've already made a recommendation because there's market liquidity there. Finally, expect the canola recommendation in the coming days. We do think our plan was to make recommendations for canola at the end of March, at the end of April, and at the end of May. We're nearing that late May period, so we should expect a canola recommendation in, very soon for canola. And that is in keeping with our opportunity risk zone chart that we outlaid at the think tank, and that showed that we were quite concerned about the risk back in December, January, February. We were looking very much forward to a March, April, May opportunity. We're right at the end of that opportunity window now, the spring opportunity window, and we're moving into a building stocks phase, a higher production phase potential. And so we want to make sure we're covering that risk going into the summer. And that is the canola outlook. Before we move to wheat, is there any questions?
Yes, there's a question.
Okay.
We've been really forward looking. One of the questions though is taking us a little bit farther back to like present day now, with respect to the funds. And so this is both for beans and canola, but with everything that you've been saying about the risk in the market, have the fund activity been like in agreement with you in following that, or what do you think the funds have been doing?
Oh, well, funds have been covering short positions. So funds had been selling aggressively, probably in advance of some of these longer term fundamental views that we see, right? So funds had been selling all of last year. It's normal for a speculative fund to want to reduce risk when market volatility increases. And so that's what we've seen. We've seen spring market volatility increase, and we've seen a lot of the fund short positions come back out of the market, right? So they're buying back their short positions, and that buying pushes markets higher. That's a normal thing to happen at this time of year. It's normal for funds to buy out of positions. We would expect to see that. And that provides those opportunities that we hope for in the spring when funds, especially when they're short, when funds kind of buy grain. Sometimes they're not short. Sometimes they're going long during this time frame when there's severe weather problems. That still could happen. But at this time, with big carries in the market, especially in canola, there's a natural tendency for funds to want to stay short, to capture the carry. And so while funds have been big buyers in recent weeks, that fund buying interest may start to slow, especially as they get to a neutral position and not net short. So I think the question was, are the funds in agreement with the long-term outlook? I don't know, because I'm not at a fund, but generally speaking, we want to use that money flow as opportunities. So if the funds are giving farmers a chance to sell at profitable prices because funds have been buying, and we can sell to the funds who are buying at profitable prices, then we should use that opportunity, given the long-term fundamental outlook being quite heavy.
Thanks, Ed. That's all we've got for now. So you're good to keep it rolling into wheat.
Okay. So wheat, it's interesting that we talked about the funds, because the funds are another story there. They were heavily short, record short, in some cases, wheat markets, and they've been buying the wheat market now based on weather concerns in Russia, weather in Kansas. Still big carries in the wheat market, right? So for a fund to go long any commodity, you want to see inverses in the market, right? Where the front month price, the nearby price is higher than the deferred prices. And for the futures market anyway, that's not the case for wheat. So we have to ask ourselves, okay, funds have been buying. They're probably net neutral now. They've probably bought back a lot of that short position. What's going to take for them to go long in a carry market? Well, it's going to have to be a total crop disaster in Russia, right? And we'll go into, is that the case? Are we seeing a total crop disaster? Well, let's have a look. So there is acute uncertainty right now about Northern Hemisphere wheat crop ability to withstand weather adversity. And I think everybody is asking themselves, is wheat really a weed? Because weeds should be able to get through this weather adversity. And I don't know, the Mother Nature is really throwing a lot at the wheat crop in the Northern Hemisphere in the last little while. So we'll see if wheat is really a weed by the end of this. Now, the rule of thumb that I always used to use is uncertainty during the growing season is bullish versus uncertainty during the demand season is bearish. Because if you're not sure about demand, oh, I don't know if the demand's going to be there, that's usually negative to prices. Uncertainty during the growing season, oh, I don't know if the crop's going to be there, that's bullish. That's the rule of thumb. So we're seeing uncertainty. It's during the growing season, has been bullish. Primary weather drivers for wheat, Russia and Kansas. There's drought and frosts in Russia recently hitting the headlines. It's been bullish. Kansas drought as well, also been bullish. We'll see if that's going to continue. Kansas has received some rains. We're going to get some good yield reports out of Kansas over the coming days. That'll help us figure out whether Kansas is truly in the drought. Russia's a little bit harder to figure out, and we'll go into that in a moment. Secondary weather drivers for wheat, there has been excess moisture in Europe, so that's kind of supported things, although that story has waned a little bit because generally crops like moisture. So while there is some, you can't have too much moisture. It's more the case that across Europe, the rains have been generally beneficial for the wheat. It is dry in Western Australia, so that's some they're trying to seed a crop there. The flooding in Brazil, Rio Grande do Sul in Brazil is about 50% of Brazilian wheat acres. Not a huge grower in the global scheme of things, but a secondary weather story nonetheless. The question now to answer for wheat is, has the market priced in weather uncertainty? So from the mid-April lows, since the start of the weather story in wheat, we've seen Chicago gain $1.40, Kansas hard red winter gain $1.40, Minneapolis has gained $1 a bushel, and Matif in Europe has gained the equivalent of $1.30 US a bushel. We're now seeing Chicago and Matif prices, especially, so your global benchmark is Chicago soft red winter and European Matif wheat. They're now trading at levels that were last seen in July of 2023. That was the peak of the Kansas drought last year. That was the peak of, not the peak of uncertainty in the Black Sea, but that was a high uncertainty in the Black Sea with Russia backing out of the Black Sea grain corridor. So huge uncertainty in Russia and in the Black Sea last summer. Huge uncertainty for the Kansas crop. And now we're at prices for Matif Europe anyway that match those prices last year. And you have to ask yourself now, are the problems as bad as they were last year? That's the question to ask right now. Do they justify the prices that we saw last year in July? Well, the market did get a boost from the USDA, world wheat ending stocks down another year. A lot of the analysts had been predicting rising global ending stocks, or at least flat global ending stocks for wheat. USDA cut the Russian crop, and global ending stocks were lower for the 5th year in a row, according to the USDA. So they cut the Russian crop by about 4 million tons versus expectations. So Russia is pegged at 88 million tons. If you recall, last year they were a 92 million ton crop. Some people saying the crop is even as big as 100 million tons. So Russian wheat production being cut, that was a big boost to the market last week. Russian wheat exports, however, still very strong. So how can they cut the Russian wheat crop but also have these massive Russian wheat exports over 50 million tons. Well, it's because Russia's been carrying a lot of wheat. So Russia is expected to draw down on some of those inventories and continue to export a huge amount of wheat onto the global scene. Russian wheat ending stocks are expected to decline because of it, down to 8 million tons next year, down from 11 million tons this year, and down from 14 million tons 2 years ago. So Russian wheat ending stocks are going to decline, but they're going to export a huge amount of wheat still on the global market. And that's, I think, what the market's trying to chew through, is that they're saying, oh, by the end of the year, stocks should be tighter. But in between, we still are chewing through a huge carry-in of Russian wheat, despite the fact that they're having current crop condition problems. So in Russia, we are seeing weather problems in southern Russia. So southern Russia produces about 75% of Russian wheat, and the other part is spring wheat. And the southern parts of Russia are quite dry. They've had, half of the normal precipitation. The northern parts of the Russian winter wheat growing region saw frost last week, -4 degrees Celsius across some of those areas. So definitely some weather adversity in Russia. They export about 25% of global exports. Now, that being said, timely rains have occurred over the past 2 weeks. So some of those parts of southern Russia have received in the past 2 weeks anywhere from 1 inch to 2 inches of rain, and that has improved crop conditions there. So while the net deficit is still a problem, is still a concern, we have seen crop condition ratings in Russia improve. So the latest vegetation health maps show that southern Russia actually has above average vegetation health, and they have benefited from those recent rains over the past 2 weeks. And I think the market is worried that the crop could have been damaged, but they're starting to see, oh, well, maybe the Russian crop will pull through this weather adversity. It never used to be this way. We used to have boots on the ground in Russia, but after the invasion of Ukraine, Russia ejected most of the international presence in the domestic market. The market is doing a lot more guessing than they ever did before. The uncertainty, remember, during the growing season is bullish, and Russia kicked out all the people that we have contact with that could tell us what the crop's really like. And so there's a lot more uncertainty about the Russian crop now than there was before. Now, there is some ability to get some idea about what the crop is there. We've got some intelligence that suggests the crop losses may be overblown, and that would be supported by the vegetation health maps as well. The thing is, the market will continue to trade the perception of Russian crop losses for a few more weeks until you really start to know. So we're going to get some volatility. Wheat market's down today. Rains in the forecast for Russia. Kansas crop tour may be looking okay. In about 3 to 4 weeks, Russian harvest is going to begin. Then the market's going to really know what really happened with the drought in Russia, and whether or not the rains that are in the forecast are going to do anything for that crop. So still some volatility to come in the wheat market. Still probably some opportunity, but we want to be vigilant. We want to maintain a defensive stance. U.S. wheat ending stocks expected to grow year over year. So bigger crop in Kansas this year versus last year's terrible drought. Ending stocks in the United States expected to grow about 10% year over year. If you just look at spring wheat, North American spring wheat, so Canada and the United States expecting to see growing spring wheat stocks year over year by about 15%. So some domestic headwinds in the new crop right now being offset by global production uncertainty for wheat. So what does that mean? What does that mean? Okay, so we've got bullish stories, we've got bearish stories. We've got a market that has probably carved out a floor. We've got a wheat market that is now probably testing the upper limits of its pricing potential. Remember, the last time we were this high in prices for the global benchmarks like Chicago and Matif was when the Black Sea grain deal was falling apart, was when there was a historic drought in Kansas. That's the last time prices were at this level. So we're probably testing the upper end of the pricing potential for wheat right now. At the same time, we've probably limited the downside potential in the market because there are legitimate concerns about the Russian wheat crop. So current bias on wheat price range, $8 is probably about fair value. That's kind of my feeling right now. Anything in that $8 to $9, especially if it's over $9 a bushel, is a sell, right? That's the limit of our pricing potential right now based on our current pricing models. Meanwhile, $7.50 a bushel and lower is likely a hold, right? So that's getting down below the cost of production. That's getting down below some of those levels that we saw back in March. And that's probably a hold at those values. So that's our range. Call it $7.50 on the lows, $9 on the highs. We want to sell the high of the range. We want to avoid selling the lows of the range. We are at 90% old crop, 40% new crop sales recommendations. I think that should be seen as a minimum given the opportunity the market's offering right now for pricing. We would make a further sales coverage recommendation this summer for wheat. And if there's liquidity, given the rally that we've seen, I would encourage growers to consider selling a little bit of that 2025 crop. Some good values out there through price locks, especially if you're looking at the CPS market, which is more liquid, to lock in CPS price lock values at in that $7 range, which for Kansas wheat is historically a very strong level. So look at that 25. I encourage 5 to 10%, and we may make a recommendation as well, an official recommendation if we got liquidity out that far. So that is wheat. How are we doing?
You're doing pretty good for time, and there's a couple questions in here. So first question is, all of this volatility and this news, some of it being bullish about wheat, is a catalyst to get the funds to move around again. So do you know, is it possible at all to ever figure out like an approximation of how much of the move has been amplified by the funds versus like what the market, like, is there any math to that?
Not specifically. There's some guesswork that you can do because in hindsight, so on Friday, we will see the fund position as of the end of the day today. So what were the funds? Were they long or short as of the end of May 14th? That report will come out on Friday. And so from there, you can see, okay, well, the funds bought or sold this many contracts in the previous week. And then you can correlate that with the amount of contracts that were traded in the market during that week. And you say, oh, the funds were responsible for, I'll give you an example, 20% of the market volume. Oh, okay, well, and then you say, well, 20%, you kind of do some fancy math and you say, well, that maybe was responsible for, 50% of the price move or something. You can try to guess, kind of back your way into how much of the price move was a result of the funds, but you never really know. I mean, at the end of the day, the price of the market is the buyer and the seller coming together to agree, whether it's a fund that's buying or selling, whether it's an end user, a flour mill, China, Brazil. At the end of the day, the price is just them agreeing on a price to trade. And whoever needs it the most will pay the most, whether it's a fund that needs it the most or a flour mill that needs it the most, whether it's a farmer that needs to sell that grain to pay a bill, whether it's a fund that needs to sell the grain to get out of a position. So you never really know why that trade occurred at any given time. You're always just guessing.
Another question is, on your graph that had the world wheat carryout, do you know how much of that position belongs to China?
Yeah, for sure. China is about 125 million tons of global carryout. And so what are we looking at here? About 257 million tons. So China is about 125, 130 million tons of that. So global non-China carryout is about 130 million tons. China has about half the world's wheat, put it that way. China carries about half the world's wheat in their stocks.
That's it. That's all the questions for now.
We used to split China out of the world wheat ending stocks because China was not a big buyer or seller of wheat. They didn't import a whole lot, but China is now a big importer of wheat, the world's largest importer of wheat, actually. And so it's now become valid to include their ending stocks in this calculation. Okay, we'll go into barley, corn, and feed grains. So Canadian barley demand, that's been the big problem this year. That's been the big headwind for barley. This is a chart here of exports, Canadian barley grain and product exports. So that includes malted barley. We see this year in the red bar is this year 2.6 million tons of barley exports in Canada, which is a normal number, except for the fact that the year before we exported 3.5 million or 3.8 million tons. 2 years before that, we exported 4.3 million tons of barley. So this year's 2.6 million tons of exports is pretty low, and actually it's on par with the 2021 drought. We actually exported more barley in the 2021 drought than we have exported that we're thinking we're going to export this year. And that's been a problem. Now, we do anticipate next year barley exports are going to increase significantly, 3.7 million tons. So we anticipate that the lower prices of Canadian barley ought to stimulate some export demand for next year. And I certainly hope they do, because if they don't, it's going to be quite heavy. The good thing is that the evidence suggests that we have seen increase in exports in the past, give it 12 weeks. We've seen barley exports kind of average around that 60,000 tons per week. And that has been, very, very good over the past few weeks. And it's putting us on track to hit our export target for the rest of the year. We've got to export about 25,000 tons per week for the next couple of months to hit our target at 2.6 million tons, which is pretty low. So the good news is that the lower prices have incentivized some export demand for Canadian barley. So also some crop issues in Europe and Argentina have probably added a little bit extra demand there for Canadian barley too. So total feed demand is pretty stable. So the export demand has been really poor this year for barley. Feed demand is fairly stable at 5.2 million tons. We have seen a large influx of corn come in to Canada. So the lower prices of barley in Canada haven't really stimulated a huge amount of extra barley feeding. Why? Because corn's just as cheap. And feeders in Canada have kind of structurally shifted towards corn. It's not just a substitute anymore. It's actually become just as important as barley in feed rations because of its availability. So Canadian feed demand pretty steady this year at 5.2 million tons, 5.5 next year. And that is more or less an average over the past 10 years. So the thing is, we've got really poor exports this year. We've got stable feed demand. And what that has caused is a massive, almost a doubling in Canadian barley ending stocks. Our current forecast is 1.4 million tons of ending stocks to close out the year. Last year, we were only looking at about 700,000. So Canadian barley stocks expected to double. Next year, also fairly large, because Canadian barley exports are not expected to recover to record levels or anything like that. Corn imports into Canada are also expected to stay strong. So Canadian barley stocks next year are still going to remain fairly high, just slightly tighter. Even if, and I think this is a big question, is, well, barley acres are coming down, so stocks need to come down too. We've stress tested the balance sheet. If barley acres drop 10%, ending stocks would still come in at about 800,000 tons. That's assuming demand doesn't change at all. And so if acres do fall for barley, it would definitely help support prices, but it would not be a major bullish input. It would probably just make sure that we don't drop any lower than where we're at, right around where we're at today. or at harvest. So just something to keep in mind. The really good thing for barley is that we've seen global prices jump. This is French barley prices in France, 237 euro at the high end of the range, and Rouen, which is a big barley hub for Europe. So global prices have jumped. It's nice because Canadian prices are a high-priced island right now, and we were worried that Canadian barley prices would fall to meet global prices, but we've actually seen global prices come back up. The thing is that French barley price, when you work back the freight and everything and currency, it only equates to about 470 a bushel interior prairies. So the nice part is that global barley values have increased. Unfortunately, it just kind of takes the prices to where they're roughly at today in the prairies for $75. We've seen even some prices in Lethbridge, closer to $550, but we're not seeing a lift really from global values rising. More so just the status quo. So this kind of, if you remember back to the beginning of the presentation, we thought barley prices are probably more of a maintain, right? We're not like uber bearish barley right now because we've already fallen so much, but it's definitely maintain a defensive stance. So where you can see, break even or slightly above break even, make those sales on barley because we're not likely to see any major rallies given the high ending stocks of barley and of corn. So US corn ending stocks quite high this year, expected to grow next year. USDA calling for huge demand increases for corn, but still not offsetting the big carry-ins from the last couple of years. So big corn stocks in the United States, going to keep a lid on barley rallies in Canada. Total corn supply, so that's total production plus carry in from the previous year, close to record highs. So lots of corn in the United States to keep a lid on those feed barley values. And of course, your malt then is benchmarked to feed. And then finally, total world corn supplies. So again, total production this year plus carry in from the previous year at a record. So you could argue that the world is awash in corn. There is certainly some weather concerns in the United States with planting and weather concerns in Brazil with dry conditions in Mato Grosso. That, in my opinion, is a selling opportunity for feed grains, especially for corn, because when you look at the total global supplies, it doesn't look like we're going to be running out of corn anytime soon. So that would mean it's a pricing opportunity. So if we just take everything all put together, barley stocks in Canada are burdensome due to a collapse in export demand caused by competition with Australia, Europe, Russia, Argentina this year. Even if we do cut acres by 10% in Canada, that still leaves barley stocks comfortable. Prices will struggle to rally against near record US corn supplies, and corn is coming into Canada. It's kind of the path of least resistance because corn exports have been restricted by the Panama Canal restrictions out of the Gulf of Mexico. So corn it's actually easier to export corn to Canada than it ever has been before. The thing is, though, we probably have reached, I don't want to say we reached a low because stocks are so burdensome. And if the United States grows a record corn crop next year, then corn prices are probably going to come under more pressure. But right now, today, we've taken so much out of that feed grain market. We've taken so much out of corn, out of barley over the past. We've probably reached a kind of maintenance zone, a more stable price for the barley market. So for now, we are in a maintain type of attitude towards feed grains, towards barley, especially. We recommend wholeheartedly being 100% sold on old crop barley, though, and 40% sold on new. So given that positioning, we recommend maintain. If you're undersold on those, then we recommend getting caught up for sure. How do we get to where do we develop a new bull market for feed grains? We need to chew through these record global feed grain stocks. That's going to take time. It's going to take time and a few weather issues. So for now, it's a maintain the defensive stance for feed grains. And I think we'll flip it over then to you, Gerard, or unless there's any questions on that.
There are no questions, and there is one more on wheat, but we're gonna continue on, and at the end, if there's time for that question, then I'll circle back, or Ed, you can do it in the chat.
Okay.
So we'll pass it to Gerard.
Okay, just want to see if I've got everything here. Yeah. So we're going to dive into lentils here. Oh, what's the word? Few talking points on lentils. We're going to just look at the seeding in Canada, Australia, India. We're going to look a little bit at the weather markets in especially Canada and India. We're going to revisit our exports and look at productions, and then we're going to look at our seasonals and expectations going forward, and then sticking to the marketing plan. Looking at the seeding calendar, the first couple that stood out, that's standing out, would be Australia, Canada, and India's Kharif crops. And we're going to start focusing on the May situation, yes, where seeding starts in Australia. It's well underway in Canada already. And in India, we're kind of waiting for the monsoons. Monsoons are going to start end of May. The IMD, which is the Indian Meteorological Department, forecasted a 31% chance that weather in India or the monsoons in India should be above average. And as of today, they're calling for like 106%. We'll get another update end of May, and then we'll reevaluate that as well. And as we are moving forward, so the risk is as we get closer to August, September, we'll see seasonals change depending on how weather plays out in India, in Canada, and Australia. That's kind of dictate the price on lentils going forward. Just another thing that I need to mention on India. So Indian weather is top of the news now as well. April, they experienced super high temperatures, and the reservoirs are at extremely low levels. So the forecast for an increase chance on above normal monsoons is advantageous for India, and we're keeping a close eye on that. Just to bring it to the vegetation health, as we can see here, this is the Pardesh regions where most of the pulses are grown. It's trading above, or I would say it's trending above the average, and it's within the range bound. And as we mentioned, like it's early in this season, so starting of the new crop, chana now, the Kharif season, which would be the chana, and some of this, which is the chickpeas and the lentils, are going to be seeded now in India. Bringing it back to their production, this year's production, as you remember, in previous MarketSense lives and previous weekly updates, we mentioned that it's a hair record compared to 2017-18. This now, however, there's some rumors that this is questionable because prices are not really moving. Prices are staying stable. So there's two ways that we can interpret this. Farmers are not participating in the market. Local prices are below the minimum support price, and farmers are probably more selling towards the minimum support price, which is limited tons, which the government in India is building stocks. So we're not really seeing prices move higher or lower. They're kind of like stable, we'd say. Or we can interpret that the market is just taking a wait and see approach and see what's happening with global stocks. And by that, we mean like what's going to happen with the monsoons in India, what's going to happen with seeding in Canada and Australia, and how weather plays out in those regions. If we shift focus to Australia, so once again, there's one or two things that's shifted, standing out from Australia. The final production numbers is questionable again. Why do we say that? Because we did see it in the past that they are exporting more than they are producing. So as of yesterday, they've exported about 860,000 compared to a crop of 1.37, or call it 1.4, just to round it off numbers. So if that holds true halfway through the year, if they export another 100,000 per month, they run the risk of running out. If that is true, prices should rally higher, which is not the case. So the thesis or the bias would be that once again, Australia is underestimating their production at this stage. So we'll wait for the Abaris report to come out to give us more proof of that. But at the moment, the numbers or the price indication is showing us that that is not true, and there's potentially a bigger crop in Australia as well, because we're not seeing prices move. If we bring it back to Canada, we can see here from our seasonal exports, and this is the CGC data, it's lagging by 6 weeks or so. As we can see here, we are for December, Jan, Feb, we did see demand drop well below the 5-year average. For after combine September, October, November this year, we saw a lot more sales go into India, a lot more exports. As we are moving to a March, April, May 2024, the trend should be, or the 5-year average, we should see demand step in, which we have not seen yet. As you see, March is lagging. So that would kind of indicate that the market is taking a wait and see approach on what's going to happen with Canadian lentils, seasons, seeding, as well as with the Indian and Australian, and the market is just taking a wait and see approach on lentils. If we shift the focus just to green lentils, just to show everybody here, we have seen a huge demand for India, Algeria, even Colombia, and even Turkey on green lentils. Green lentils has been top hitting the news this market, and we've seen an increase in demand for green lentils, mostly for the reason we saw a unexcited or a poor pigeon pea or tur crop in India as well, and we saw a huge demand from India happening there as well. The watch out, however, if we look at prices on green lentils, we can kind of see here that green lentils have diverted away from red lentil prices, and they're a huge premium for green lentil prices on smalls and mediums. Looking at new crop now, we have discussed this in previous weeklies and in previous MarketSense lives as well. We are expecting green lentil acres globally to increase. The US is increasing it by 44%. Canada is increasing green lentil acres as well. Even Russia, Kazakhstan is increasing green lentils acres as well. So everybody's chasing the higher prices, the higher profit margins. That this is where the risk is. So from a MarketSense point of view, we're keeping a close eye on seasonals, on all lentils combined, and we'll look to move to a new recommendation on new crop within the next 2 weeks to 30 days, trying to capture the top of the market. Have a discussion with your advisor, have a discussion, especially if you're seeding green lentils, know your risk, manage the risk accordingly. And we have been talking about this throughout think tanks, throughout now, and we are ending the end of our seeding selling, our spring selling program. So just another discussion on green lentils and lentils combined. We are 100% sold on old crop, taking all the risk off there, and now we're starting to focus on new crop going forward. Any questions on lentils?
No question. So you can go ahead and move into peas.
Okay. On the peas, we're just going to look a little bit on the demand side. So just to put everything in comparison, if we look at the China cumulative demand spread over the crop here, we can kind of see here, and we did talk about that in Think Tank as well in the China presentation, that China is moving in a different direction. And we can see that here with the peas. So demand for peas into China has been disappointing. However, if we look into India, we've seen a lot of peas, yellow peas, move into India, as we mentioned, for reasons on their pigeon pea crop and just the demand into India. We saw from November, December, Jan, Feb, that we saw a huge increase in demand to India. Coming into March, we'll look at the chart here now, that we have seen it died off, but India has been extending the tariff-free on yellow peas into end of March to end of April to end of June and now end of October, which is convenient in line with our new crop that should come off the combine. So there might be an opportunity here off the combine to refill the pipeline as the extensions on the tariff-free imports into India has been extended to end of October. So just be aware of that as well. Have a discussion with your advisors on how to manage that risk and how to take some of that opportunities, to lock in some of those opportunities. If we look on a pea exports by country compared to year to date, this is the visual here that we can see that India year over year is extending that, and the demand is there quite often. The risk, however, with India is if the demand or if their crop that they're going to see in the Kharif season is decent or they have the monsoon rains, the risk of demand disappearing is possible. the risk of a Russia or a Kazakhstan increasing yellow peas acres as well is possible as well. If China steps back in and we see the same demand for China, that should support prices. So we're moving into a scenario uncertainty where upside potential is getting limited, and there's a lot of uncertainty in the market as well. And this is why we moved on recommendations yesterday to just manage some of that risk. We will get some more opportunities as the season goes on, but be aware of the risks and manage risk accordingly. To bring it back to Canada, if we look here, we can see when when India started stepping in for demand, December, Jan, Feb, exports from Canada into India ran up well above the 5-year average. And as you can look at the March here, we almost exported 0 tons, well, not zero, but like barely anything into the March timeframe here as well. This just shows us how thin liquidated market the peas really is, and then not everybody's willing to take on the risk. Because if you remember, this is when the first expiration of the extension was end of March, and nobody was willing to take on the risk from the buyers or the transport side. Now with the extension till end of October, within our seasonals, we'll probably see demand step in, especially right off the combine. With the new extension to end of October, if the buyer or exporter has the bill of lading before end of October, it would be accepted into India. Being critical about it, I just want to divert our attention back to 2017, 2018, when we saw some similar type of demands and just disappearing. We're still dealing with a high risk country here. So the extension could be stopped, or there's a lot of risk out there as well. So just manage the risk accordingly and don't put all your eggs in one basket when dealing with peas. From a seasonal point of view, like we did mention, we did move to 100% recommendation on old crop, and we did some new recommendations on new crop as well. From a seasonal point of view, we'll keep a close eye on seasonals, expecting to do more recommendations right off the combine if we see demand step in, and we should see prices being supportive of that as well. This, however, is still all weather dependent, and there's a lot of uncertainty on weather within Canada, within Russia, Kazakhstan, and then within India itself as well. Is there any questions on peas?
Nope, there are not. So go ahead and keep rolling.
Okay, on durum, we're going to talk about weather. We're going to talk about Turkey, Italy again. We're going to talk about the turkey production again, and then we're going to focus on North Africa. And then Canadian seeding for durum at this stage is 20%. Global seeding, not global seeding, Canadian seeding, as Ed mentioned, a little bit higher. If we look at Turkey vegetation health, Turkey is about, they started harvesting in some earlier areas where the irrigation was. Normally the harvest starts at end of May, but they are a week, 2 weeks earlier and really started seeing some harvest come off for Turkey. The first harvest that normally comes off is at the stuff that's higher above sea level, which is the lower quality stuff. So we are keeping an eye on it as harvest progress on. Looking at the vegetation health index map compared to last year and the 5-year average or within the range, we are at the top of the range, which should suggest that they have ideal conditions, the potential for another big crop in Turkey. So to break down the numbers, just to give you a couple of talking points on Turkey, the average production for the last 10 years in Turkey was anywhere from 3.2 million metric tons. 2013, 15, and 23, they averaged above 4.1 to 4.3 million metric tons. And if you remember, 2023 was the record crop of 4.3. 2024 is forecasted at a 4.3 to 4.5 on the lower end. So if we do the math, a big crop can still get bigger. This is if we have below average yields. Looking at what we saw in the vegetation health index, it would show us that we might expect higher than expected yields. So the range from 4.3 to 4.5 might be modest, or we might be underestimating it, but we'll just stay for that at the moment. I mean, we have seen that Turkey is a bigger role player now in recent years, and especially the last 2-3 years. They are not a one-hit wonder. They're here to stay. They're here to reinforce or solidify their market share. Turkey's been an advantageous re-exporter into Europe on durum as well. So if we look at the Turkey production, it's forecasted at a 4.3. If we do the math and say that they have an or a slightly above average train yield, we run the risk of them surpassing the 4.5 or even getting close to a 4.7 million ton crop, which is a huge crop for them because their 10-year average is at 3.1. So they're suddenly producing 1 to 1.5 million tons extra compared to their 5-year average. And it's just basically because they're chasing the prices. Prices has been advantageous for durum, and now Turkey is stepping in there. Shifting our focus to Italy and then North Africa. Italy, Sicily, the Sicily island and the southern parts of Italy has been hit by a lot of drought. There are concerns there as well. It's hitting the news. A lot of people are concerned about it. They have started harvesting in Italy, which is about 2-3 weeks ahead of time, just because of the dryness. So now you may say, well, why are prices not rallying in Italy? Well, the market prices in Italy is kind of staying stable at the moment, so it's taking a wait and see approach. So yes, there is concerns, but the prices would indicate that the market is comfortable and just waiting and seeing. So we're not seeing prices react to the dryness or the concerns as yet. Can that change? Yes, that can change, but as of today, we're following the price tendencies and price kind of staying stable in Europe. If we bring it back to Canada, with all the lovely rain that we had here in a little bit, and it's raining again here in Moose Jaw today, I just want to bring our attention that planted acres, we are looking at a 6.3. And if we draw the line here, that's the highest seeded acres since 2001, 2000s. With the rain out here, and Ed kind of talked about it, it's too early to say if we'll have a average yield or above average yield, train line yield. The market is penciling in a below trend line yield. So any changes that we see in weather, or if the market started saying that, well, Canada's setting a record amount of acres, the highest in 20 years, above trend line yield, or even a trend line yield, what's that going to do for production? This is the reason why we are taking a aggressive stance on our recommendations and trying to protect profits. Bringing it back to our seasonal durum cash prices, the durum market is on the verge of changing the seasonals, which is interesting because we normally follow a 5 or 10 year average, but with Turkey being another European, another Mediterranean, Canada with producing the same, it has the opportunity to change the market from a seasonal point of view. From a marketing point of view, we're going to keep a close eye on seasonals. And if you remember last year, because Turkey was a big role player, once we got into harvest, we saw the high of our prices and prices started dropping off. Where normally we see, from a Canadian point of view, more opportunities throughout the year. This was not the case this year. So going year 2 into it, and Turkey not being a one-hit wonder, we're going to keep a closer eye on it as well. And the plan would be, once we get into June, July, as the crop is established, to be a little bit more aggressive on recommendations and moving towards a 40 to a 50% new crop sales right before we start harvesting. I am aware that there is a lot of risk with durum, but have a discussion with your advisor. Take the whole farm into account when managing risk on the non-hedgeables as well. Any questions on durum?
There's nothing in the chat here, so we're good to
roll
into the last topic, or potentially second last, but probably the last. You're on mute, Ed.
Sorry about that. Can you see my screen yet?
All we can see is barley and corn.
Okay. Let me try sharing again. I wasn't getting. Okay, There we go. Okay, so oats. Oats is, from a futures market perspective, quite exciting right now. The challenge is that the futures market in Chicago doesn't efficiently transmit price signals to the cash market in Canada. It does have some indication about what prices might do here domestically, but the dollar a bushel or so of rally that we've seen in Chicago oats is probably not going to be translated directly into Canadian cash prices, but we are quite optimistic on the kind of the short-term future in oat prices. So the chart that I've put up is the July oat futures contract in Chicago. I think the market back in April, when it was hitting lows of $3.25 US dollars per bushel, was thinking that demand was quite poor. And I mean, it was. Demand was looking pretty feeble this winter. But the thing that we talked about at Think Tank was that the oat market will rally to prices that will restrict demand, and that's what they did back in August. Oat prices rallied above $5, up to $6 even here in cash markets. That stopped demand. We saw the effects of that through the winter as prices fell because demand was poor. Prices fell quite low in March and April, and that prices falling low actually brought demand back into the market. And the oat market's pretty sensitive that way because ending stocks are quite tight. And so now we're seeing demand come back in and the prices are running on the futures. Hi there. Teams just kicked me right off. So
It's flaked out on you. We'll give it
yeah.
a second to come back.
I don't know what happened there. It just says, "Oh, we run into a problem," and they just boot me off. Like I wish I could use that excuse sometimes. I ran into a problem. Bye. Okay. So July oats, again, rallied significantly in the futures market. Cash market is, I think that's reflecting a cash market tightness. And how soon are we going to see that in our domestic cash markets? I think we've seen some appreciation in prices in the last little while, but not $1 a bushel. So are we going to see it? Are we going to see that, Buck? Let's see. Global oat ending stocks are tight. So I think this is part of the story, is that globally ending stocks in some of these other countries like Australia and Europe, South America, global ending stocks are fairly tight relative to where they were, say, earlier in the decade in the 2010s and 2013, 14, 15. The idea there would be, okay, well, global prices, because global oat stocks are fairly tight, global oat prices should rally. And we've seen that through October, November, December, January, February, March, April. We've seen prices in Australia. We've seen prices in the UK and Europe rally significantly on global markets. Global oat prices are around 340, 350 US dollars per ton, which is quite elevated, right? That's well above $5 and $6 a bushel. In Canada, however, you have not seen that. Canada's been probably the most affordably priced oat market in the world. And in a normal market like canola or wheat, that spread would narrow pretty quickly. You'd see the United Kingdom with high prices would import Canadian wheat or canola, and that price would come together. With oats, the market is not interested. It doesn't like transporting bulk oats. It's expensive. It's a very high volume, and it's a low priced commodity compared to other commodities. So there's a lot of kind of resistance to shipping oats globally. And so you don't see kind of efficient price mechanism, price transfer from high price markets to low price markets. It's a very slow process. But you're starting to see that first kind of indication here. This is Manitoba on this chart, that Manitoba prices are starting to come up. I don't think that you will see prices reach Europe. I don't think that that's what the oat market is going to do, but we ought to see exports improve. And does the evidence show that? Yes, we have seen in the past 8 to 12 weeks exports start to improve for oats in Canada. Most of those exports have been going to South America, Mexico, Colombia, Peru. Sorry, not most of those exports go to the United States. About 80% of Canadian oat exports go to the United States, but the other 20%, that's more than normal, has been going to Mexico, Peru, Chile, that sort of thing in South America. So that's been really good to see that oat exports have responded to those higher global prices, Canadian prices starting to respond as well. And they ought to, right? Because Canadian ending stocks, as we chew through the enormous carry in from the 22-23 crop year, we've also seen acres in Canada absolutely collapse last year. And so ending stocks for oats in Canada are quite tight. That being said, well, they're supposed to be tight next year, assuming demand stays robust. That being said, demand is a question. Demand has fallen from the record highs that we saw, in the early stages of the pandemic when everybody was eating granola bars and oatmeal at home, working from home. We have seen oat demand fall since then, and it is a big question. Is that structure? Is that demand for at-home breakfast and that sort of thing? Is that structural or is that more elastic, right? Will that change? So demand's a big question. Furthermore, acres are a big question. Oat acres in Canada are expected to rise significantly next year. The market is counting on it. I think that's part of the reason why oat prices in Canada haven't rallied the same way that you've seen futures rally, is because the market's saying, I know that it's tight now, but if I can just wait till new crop and all those acres and all that supply is going to come on the market, and I'll just wait for that. Now, that's not a guarantee. And if you need oats today, it's a fairly tight market. So there ought to be some appreciation in prices. We are feeling fairly bullish on oat values today. That being said, our plan still is, broadly speaking, to defend the castle. So we do intend to make some sales recommendations in the coming days. Our plan is to make a 20% sales recommendation here at the end of May to get caught up on some oat sales into hopefully some more attractive values. So that is the plan on oats. We should be moving to a 90% sold on old crop, 40% sold on new crop here within the coming weeks. But we do see a fairly tight supply scenario for old crop supporting prices in the very short term. And that's oats. And we've got a couple of minutes maybe for some questions, and that back to you, Heather.
Thanks, Ed. And thank you guys for your insights today. There's one question I'll circle back to. We're not going to have time to get into macros, so perhaps we can deliver some of that update in a different medium. But there was a question back on wheat about whether there's any thoughts on if India will be needing to buy any wheat in the coming months.
Yeah, that's been a good question. India, so there's a lot of headlines around Indian stocks being tight, and there's been some speculation that India would buy wheat and cause prices and run prices up. And that, I think, is the problem with that thesis right there. India coming in and running prices up. The whole goal of the Indian government is to not run prices up, right? The whole goal of the Indian government is to keep prices limited. So if there was like a major shortage of wheat in India, then perhaps you would see them come in so that people don't starve. But they still have wheat, right? They just harvested a bunch of wheat. So everything that the Indian government does is to not try to import any wheat if they can. They want to produce as much as they can at home and then draw stocks down if they need to. But if stocks are tight, that's fine, because there's a new crop coming just around the corner. If India were to have to import, though, and again, everything that they do is to try to not import, is to try to stretch their stocks out as long as possible. If they did, they would be coming for the cheapest wheat on the market, which would be Russian, potentially Ukrainian wheat. India would not be coming for Canadian wheat. So the extent that Indian purchases might rally the market here in Canada would be very, very limited. And so quick answer is I don't think India is going to come and import. If they do, though, I don't think it's going to have a major impact on prices, but we'll see. They just harvested their wheat crop. They're going to have several months now to chew through their existing harvest before we see any kind of imports. Probably would be early 2025. So.
Thank you, Ed, and thank you to Gerard as well for your insights today. And we're going to sign off. So thank you everyone for attending. And if there, like I said, if there's anything you want to review, we were able to record this, so we'll be sending out a recording at some point later on today. So thanks everybody again. And a reminder, our next MarketSense Live is actually going to be not until August. So we'll send out some invites and stuff like that as we lead up to that. And I hope you have a great summer and a great growing season. And we'll see you back in a few months. Take care, everyone.
Thank you. See ya.